This achieved a recessionary level on the misery index, which is made up of unemployment and inflation. When you look at how people feel, it hit levels that are typical of a recession. Also interesting is that private sector credit also hit levels that would be seen in a recession. For example, if you look at surveys of senior loan officers, do you see that they are tightening credit or loosening credit? There was a time when about 40% of them tightened credit and the rate was going up. And you should know that in the past, when those numbers are reached and kept up, a recession followed. We learn about three main things in this new talk from Crypto Banter with Lyn Alden. How Fed rate cuts will affect Bitcoin's future, what the signs are of an impending recession, and how changes in the economy affect how strong the US dollar is compared to other currencies. Bitcoin is worth about $61,000 right now. It has lost 1% in value in the last 24 hours and 2% in value over the last week. As the 2024 election draws near and officials like Gary Gensler come under more scrutiny, the cryptocurrency market is about to go through big changes. Don't forget to like, follow, and share this channel before we look into this. Let's hear more from Lyn Alden now. When we think back to the 1990s, we tightened up on that, and then they started to loosen up on that. They started tightening at a lower rate, which is proof that you've come out of a slump as it has been done in the past. In a way, we went through this private sector credit crisis without losing credit or going through a lot of people losing their jobs. That's why I think this cycle is a little strange. I do believe that the economy is going to get weaker. I believe that the job market is going to get worse. But I don't think there will be a big credit event because the background is already exciting and we've been through a cycle of credit tightening for about 2 years. So, I believe that most of the signs we have seen in the last 40 years happened during a time when money was king. In other words, monetary policy and private loan cycles. Now I think we're more in fiscal dominance, which means that when you add a few developing markets to the way the US works, things get really hot even though they can actually be bad. I believe the economy is weakening, but I believe this is not the same as the recent restart. That's why I called it a emerging market landing. People have been asking me for a year now if I think we'll have a hard landing or a soft landing. I always say we'll have an emerging market landing, which is kind of a soft landing, but because you're pre-stimulating. There are two main ways for a recession to happen. This is another way to tell the difference between a normal decline in a developed market and one in an emerging market. Some people have a really bad time during a slump in a developed market. They lose their jobs. Most people don't feel any different. They're just worried that they might lose their jobs or get a smaller raise that year. In that way, the pain is more concentrated. The other option is for everyone to lose pay or for most people to lose real pay. In emerging countries, that's what you really see. This summer, I spent a lot of time in Egypt. The people there are worse off than they were 2 years ago. It's not because they lost their jobs either. This is because they can't afford to buy as much for things that are really better than what they used to have. And it's because the money has been taken away from them. I think people in the US have gone through something similar, though not as bad, in the last few years. Instead of a few people losing their jobs and going through that cycle, a lot of people are slightly worse off. So I think there are different levers that can be pulled to change the way a recession looks, but not the real effects, like whether more people are better off or worse off. I believe that by putting them down, we've shared the pain a bit. Yeah, so my idea there is about how the United States will have structural deficits for a long time, and there isn't much chance that they will go away in a time frame that investors can afford. 10 people. If there is a credit event or a financial event in the private sector, it usually leads to less inflation. It's ice death. On the other hand, when a nation faces a solvency event, it's usually too late. When it comes to the US, I think that will take a very long time to happen because they can control the average. They might be able to, like what happened in the UK when their bond market crashed. Short-term QE could be used to put out the fire. After putting out the fire, they stop doing QE again. I think the same thing will happen in the US. If the bond market is good, it will keep going. If something goes wrong, they can handle it the same way they did in 2019 and 2020 and other places. And I think that these kinds of fundamental 7% of GDP deficits are just the way things are in the markets right now. Very large and growing nominal deficits in a world where interest costs are higher than US war spending, which is now just a background fact. When you look at emerging markets, things are certainly more extreme, but in general, when they have problems, the prices of their assets stay high longer than you think in local currency. In terms of gold, they don't do well. In terms of money, they don't do well. But they usually have a bid in terms of the local currency because the weak part is the base. I believe that the developed markets are going through a milder, less extreme version of that, which is that things stay more bid than people think, mostly because the average is what's going down slowly over time. What we just heard was Lyn Alden talk about what might happen to the Bitcoin market if the Federal Reserve cuts interest rates. She is now going to talk more about the signs of an impending recession and the slowdown in the economy we are already seeing. Alden also talks about how the value of the US dollar changes when compared to other currencies around the world. This changes the value of risky investments like Bitcoin. Let's hear what Lyn Alden has to say now. Some countries have fundamental current account surpluses, which means that they can usually choose to have their currency go up in value against the dollar. They will go with these bigger rate cuts if there are any changes. That's always how they've been. The big fiscal component is one of the strange things about this cycle. Running a 7% GDP gap before a recession even starts is pretty rare. There's a hint of stimulation there. And so if you look at what we've seen in the markets, look at 2022, there are many signs of a recession, even though there isn't a jobless cycle. As an example, I could say that the money supply hit its lowest point in 2023 and has since been slowly rising, in part because the Treasury is kind of counteracting the Fed. Active Treasury production is one way that economists like Nouriel Roubini have talked about it. In essence, the shortening of the time that extra T-bills are issued and the draining of their reverse repos. When you look at the Fed balance sheet along with the TGA and the reverse repo facility, you can see that we haven't had much liquidity since the, let's call it, regional bank crisis of 2023. That was a rough spot. From then on, we were going sideways instead of down. Until we hit the end of the reverse repo facility, I think that will stick around. Then the Federal Reserve already thinks that by the end of 2025, they will likely return to slowly increasing their balance sheets, this time not as a stimulus measure, but more like what they did in 2019 with the overnight rate spike. They would say that we've hit the end of banks' ability to hold enough cash on hand. We want to start increasing bank funds and keep them at a high level. That sounds like the way they're going to talk about it. And I think we're entering a time where money supplies are going up, but not very quickly. This will probably last for a while. You should also think about the banks, because if they buy from non-banks, that would definitely raise M2. It will still go down though if the rate at which banks are lending money is going down even more. So it definitely needs to look at the whole picture, which is my point. Yeah. And the bank loan part is very important. And as I said before, we went through a tight cycle during which most banks were very cautious. As shown by surveys of top loan officers, they were simply saying all of our standards are going up. They're not squeezing as much as they were a year or two ago. We kind of went through this round